Are you looking to double your money? Even with higher interest rates that we've seen, CDs, savings accounts, are simply not the way that it's going to happen. When we start looking at doubling, tripling the money that you have, it is often taking some risk that is associated with that double. Now, really to achieve this level of return, there's a couple different options which do come with some risk that we're going to be talking about in this video. I'm going to be looking at 5 ways to double your money from, honestly, the least riskiest that we do have up until the very high risk. And of course, with more risk, you can have a shorter runway to doubling your money. Now, the first one we look at is getting a 401k match. This is super simple, super basic. When you think of a 401k match, if I'm putting in 5%, my employer puts in 5%, guess what? You just doubled your money right there. Very low risk, very easy to do if your company offers a 401k match. And of course, those contributions can grow, meaning that as you're doubling your money every single paycheck with the employer match, this can be a game changer for a majority of individuals. However, not everybody puts into the 401k plan. Not everybody looks for the match, meaning that you are losing out in money for your entirety. And it's kind of crazy. Now, one of the downsides with this that you could see is some companies do have a certain amount of time that you have to be employed with them. My employer, it was 3 years before you were actually vested to get the money that your employer put in there. And of course, what investments do you have access to? But even getting a 401k plan, getting double that 5%, you, regardless of the investment, really putting it in target date funds, putting it in an S&P 500, almost anything that you put it in, you're not going to lose 50% of the value because they are managed plans and they are usually brokered or really provided from your company. Now, of course, 401k plans, you got to know the ins and outs, but doubling your money instantly is very easy. Now, the second one that I look at, which again, 401k plans, I am looking at. Second one, investing in the S&P 500, which I do in my portfolio and I do on a very regular basis. Now, when it comes to CDs, when it comes to bonds, the returns are never going to be there. When you start looking into individual stocks, I do not buy individual stocks at all. I only buy ETFs, which I have a lot invested in the QQQM, also the S&P 500 and the HD. And of course, looking at a very strong option in a longevity option, it has very attractive long-term returns. When you start looking at roughly 10% return from the S&P 500 over an extended amount of time, you can double your money in roughly 7 years. If you think about that runway, so if you're 25 right now, 7 years later, you're doubling your money. 7 years later from there, you're doubling your money. That doesn't include any of the contributions that you're adding to that. That is just doubling the contributions that you already have based on the growth factor, based on the compounding factor, which can make a really big difference. Now, of course, when we start looking big picture, negative returns, which were during the 2000s, when we see the S&P 500 down, made up for it in the 2010 era, when we see the S&P 500 up 252%, tripling and more than tripling the money that you had in there. Now, S&P 500, I have a link down below for M1 Finance. Super easy to invest in. Literally, it is something you can invest and really set it and forget it, not even have to worry about it again. But before we get into our next one, please subscribe to the video. Let me know in the comments what you guys think. And looking at our third one, buying a home. Real estate doesn't seem like a very good way to double your money very quickly. But again, thinking of the risk associated with it, it is slow, steady gains. There hasn't been a point in my life that since I purchased a house 11 years ago, I have already seen my home itself within that 11 years over double in price from where we purchased it. And of course, it could lead to the homes doubling in value, which is what we've traditionally seen. Now, when it comes to a mortgage, it relies on the power of leverage and utilizing the money, not owing the money within there to really get the value. If you buy a $200,000 home, you put your 20% down, which is pretty typical nowadays. So that $40,000, you already have built-in equity, which I do not recommend people tapping into the equity, which a lot of people do doing home equity, things of that nature. In my opinion, it turns your home into more of a liability and a risk of possibly losing that. But when you start looking at the growth factor or the exponential value of the home that is growing, it has went up and almost doubled in the last 10 years. Now, of course, unlike other investments, you have to put more money in the house for maintenance. You have to do, keeping up with repairs, new HVAC, new windows, new roofs, all of that while continuing to pay down the mortgage. But of course, if you didn't have the home, if you weren't paying a mortgage, you would have to pay rent or you'd have to have something. That, of course, is the upside and the downside of owning a home. Now, looking at number 4, this is where we start getting into a high risk trading cryptocurrency. Now, when it comes to cryptocurrency, We are talking Bitcoin, Ethereum, Dogecoin. There's a big opportunity for speculation. There's a big opportunity for making money. Honestly, there's also a very big downside. There's a big possibility for losing a ton of money. And we know with the volatility of crypto, you might see, Bitcoin at 60,000 one day, 68 a week later, 62, a week after that, 54, 30. Guys, it's all over the place. If you're playing the game of trading cryptocurrency versus the buy and hold strategy, you can really soar in a couple of years if you're good at it. The bounce is significant enough that you can make some real money versus the buy and hold, and really you don't want to lose money anywhere, but especially in cryptocurrency because it can be very, very volatile. And the last one we look at, which is the most volatility we see, trading options. Now, me personally, I've seen like the Jeppy that trades options, a couple different places. You can lose money, you can double your money, or you can lose all your money. Options can be very lucrative and they are very, very high risk. And it's crazy because even looking at this article from MSN.com, they put trading options as far more riskier than trading cryptocurrency, which again is kind of interesting. Has very big upsides, very big downsides. A call option gives you a right, but not the obligation to purchase stock at a specific price. And of course, a put option gives you the right, but not the obligation to sell at a specific time. So there is a lot that goes into this. Do your research when you think of really playing the speculation in the market with if stocks are going to go up and down. That is what you're playing with, and you can actually do this. And a lot of people play this and play this game very well, but a lot of them do it on margin, meaning not only could you lose your money, you could lose, 10x your money if you're borrowing money that is already kind of out there. Now, it's kind of crazy to think that they give access in this much kind of leverage to people to buy, but they do. I've seen it in the crypto space where they give you a 10x leverage. I've even seen it through like a KuCoin where you can get up to 100x leverage on cryptocurrency, which again is kind of crazy to think that they give you access to that much money. So how soon can you double your money? That is the big question. This is where the rule of 72 comes in. Now, if you heard this, it is a very simple trick mathematically to quickly estimate when you're going to double your money. It's called the rule of 72, like I said, and the principle is very simple. Divide 72 by your expected return. That is when it is going to double. For example, if you earn an 8% annual return, it will take about 9 years for that rule of 72 to double your money. When we start thinking of that S&P 500, 10% return, so just a 2% more return, the rule of 72 goes to about 7 years before your money will double. And again, you can start really snowballing the investment, start snowballing the strategy, depending on how much you're earning from that return. But remember, the rule of 72 is a very big estimation, meaning that, the rate might not be 8% annually every single year for those 9 years to double that return. Just like the S&P 500 this year, we're seeing up about 22%, where in 2022 it was down 22%. So again, you have to take that with a grain of salt and knowing what your average return is to use the rule of 72 and knowing exactly where you're at. So the bottom line, if you're looking to double your money in a reasonable time frame, which again is about 7 to 10 years, if you can double your money every 7 to 10 years, it's going to be a game changer for your finances, building wealth, building generational wealth, unless you want to do it much faster like cryptocurrency or doing option trading, which again, do your research. You don't want it to be more like gambling than investing when it comes to that. You can build your fortune, but you don't and can wipe it out easy without knowing exactly what you're doing. Thinking of things, eliminating the risks, such as the 401k match, the S&P 500, or even owning a home can make a big difference. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.